Welcome to this episode of the Video CPA. Today we're going to be talking about federal taxability of marijuana, which some of you may not be involved in, but most of you may be interested in. I'm your host, I'm Michael Scott, and this is the Video CPA, where we talk about tax matters of interest to U.S., and sometimes foreign taxpayers as well. So let's go ahead and get into it. We have our affiliate action disclaimer, we have our affiliate disclaimer here, marketing, and we also have our educational disclaimer. So the current status in the United States of marijuana is that it is illegal at the federal level. Even though it is illegal, though, the IRS wants their share of any income produced. And if you remember the definition of gross income, it's income from any source derived, whether it's legal or illegal. And so the IRS wants to tax it, and they do tax it. So it is taxed at the state level. 34 states have implemented medical marijuana programs. In addition, Puerto Rico has implemented a medical marijuana program, which means it's legal for medical purposes in those states. And then 10 states have allowed recreational marijuana sales, growth and sales, and plus the District of Columbia. So if they allow recreational marijuana sales, they certainly allow medical marijuana programs as well. And so you've got 44 states in the United States, that are now recognizing marijuana and legalizing marijuana in some form or another. There are 6 states that are holding out, and so what you see is this is probably going to be approved at a federal level at some point in time. Whether you agree with that or not, that's the direction that we're going. And your 6 states, basically Idaho, Wyoming, I think South Dakota, Nebraska, Illinois, and Alabama. And so those are the 6 states where it's illegal to grow or to sell marijuana right now. So that's the current status. Let's look at revenue reporting. The IRS does, if you've got a marijuana business, expect you to report your revenue, even though you might be in a state where marijuana growing and sales is legal. They don't care. They want you to report your revenue, your sales on a tax return, and they want to collect the tax on it. So many marijuana businesses don't have bank accounts. They deal in cash transactions, and so the IRS has made options available at their IRS or at many of their IRS taxpayer assistance centers for you to pay your tax there. And of course, like other businesses, if you receive a payment of over $10,000, you have to report it on Form 8300 to the IRS. Marijuana businesses, like other businesses, have to file estimated tax returns throughout the year, just like individuals do and other businesses do. So they're no different than any other business as far as reporting revenue goes. The IRS just expects them to report everything they bring in. It's the expense side of the ledger that is a little bit different for a marijuana type business. So let's look at the expense side of the ledger. Internal Revenue Code Section 280E disallows all deductions or credits for any amount paid or incurred when carrying on a trade or business that consists of illegal trafficking in a Schedule 1 or 2 controlled substance within the meaning of the Federal Controlled Substance Act. Marijuana at the federal level is considered a controlled substance. And so what that means is that no deductions are allowed. They want you to report your revenue but no deductions are allowed, at least for general and administrative expenses. And so the quote you hear a lot or read a lot is that a marijuana business has to pay up to 70% of their income in taxes. And that may be the case. It may not, but that's what's quoted quite a bit, that they may have a tax rate of 70%. And that's true even if they're operating in a state where marijuana has been legalized. So what happens then is that the IRS has said that they can take expense deductions that relate directly to the product, and sometimes indirectly, but it's got to deal with the production of the product, and those type of expenses are known as cost of goods sold. All right, and so on the next slide, you'll see that Section 280E does not prohibit a participant in the marijuana industry from reducing its gross receipts by its properly calculated cost of goods sold. Cost of goods sold is covered in Section 471 of the Internal Revenue Code, but it basically are the expenses that deal with the product and with inventory. And so there's quite a bit of leeway that you have to understand if you've got a marijuana business in here. And you might consult a CPA or an enrolled agent, somebody that's got quite a bit of experience dealing with marijuana-type businesses on this, because there's some things that you can do. So let's look at what cost of goods sold are, okay? So the basic definition in accounting of cost of goods sold is you take your beginning inventory, you add in your purchases. In this case, it may be growing costs. You add in any freight or storage costs and anything else that might attract to that product. And that gives you your goods available for sale. Then you subtract out your ending inventory at the end of the period, and that's your cost of goods sold. And your cost of goods sold actually is what you can expense on your tax return. Okay. So if, for example, you have a dispensary and you are purchasing marijuana from a grower, you can certainly write off the cost of the purchases of that marijuana, the cost of the purchases, okay? If you have to have another building or a warehouse or something to keep your marijuana in, to keep your inventory of marijuana, those costs are not Section 280E type costs, and so those can be written off as well. And the rent for that building could be written off, and if you've got a manager in that building or an owner that is taking care of that salary could be written off as well, because inventory management is not part of trafficking in a controlled substance. But so if you've got a dispensary and you do have to have inventory off-site, and a lot of these dispensaries don't have much room for inventory, so that's a possibility. But if you don't have anything like that and you're just buying as you sell, then the only thing you're going to get almost is just your purchases, because you're not going to be able to get any sales expenses or any administrative expenses for running your sales office, anything like that. Now, we did have a case in California where it was a medical marijuana case where a organization was selling marijuana out of a dispensary. They had a building, but also in that building they had other businesses that complemented their marijuana sales business, or their medical business, let's say this. So they had things like yoga classes. They may have had a spa in there. Things that were also healthy. And in that situation, I went to court, and the courts decided that yes, you could have more than one business in a facility with a marijuana business. So And if you did, you could allocate expenses related to the non-marijuana business, the non-marijuana sales business, and write those expenses off because they didn't fall under Code Section 280E. So there are ways to get some of these expenses, and that's why I recommend if you're in this type of business, you need to consult a good CPA that's got experience in this area, or an enrolled agent that has experience in this area, or just a tax preparer that it doesn't matter what their credential is, as long as they've got quite a bit of experience in dealing with marijuana related businesses. So there are ways anyway. Your freight and storage costs, for example, if those storage costs are taking your marijuana and drying it, for example, those can be written off as part of cost of goods sold. So with a dispensary, it's a little bit more difficult. Let's look at somebody who has got a dispensary and also grows marijuana. So if you're growing marijuana, you may have payments on your land, and you may have to buy plants, you may have to buy seed, you may have to buy fertilizer, you may have a manager that's overlooking your marijuana growing, and all that stuff can be written off. There may be equipment that you have to use to harvest your marijuana. There may be equipment that has to be used to plant your marijuana. So those are all related to cost of goods sold. Those are related to the production of the marijuana. Those are the types of things that are covered in cost of goods sold and then can be written off for tax purposes. Okay, but once that product is complete and it goes to a dispensary, well, then there's really nothing else that can be done after that, unless you've got a situation like I just explained of more than one business in that dispensary building. Okay. So those are some things to think about. Your inventory management. If you've got a separate building, for example, that you've got your inventory in, like I say, that might not fall under 280E, and you can write off some things on there. But good CPAs or enrolled agents or tax preparers can help you out quite a bit in these areas. So that's the presentation. That's where we are with marijuana in the United States right now, and like I say, it looks like it's going to be a done deal one of these days as far as being legalized on a federal level. There are movements afoot that will actually take marijuana out from underneath the cover of a controlled substance, which would then make it legal. So, and marijuana growers could actually write off all their expenses. But we'll see how this plays out. But anyway, I appreciate you watching, and if you got any questions, put them down in the comments area or any other comments. And if you like the video, check the like button, thumbs up, and if you haven't subscribed yet, hit that subscribe button. Thank you very much.